Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today, we're diving into an 8K filing from FTI Consulting. Think of it as corporate code switching. They are telling investors a story, and we're here to see if it matches reality. Let's see if their rosy picture stands up to scrutiny, or if it's just a house of cards waiting to tumble. FTI Consulting just dropped their latest financial report like a beat in a song. It's an 8K filing, which is basically a company saying, hey, big news, to the Securities and Exchange Commission, or SEC. This one's dated February 20, 2025, so it's fresh off the press. Basically, it's a snapshot of how they did in the last 3 months of 2024 and the entire year. They released a press statement about how the company did financially for the 3 months of the year and the full year that ended December 31, 2024, and they also talked about what they expect for the full year ending December 31, 2025. It is like a report card and future plans all rolled into one. It seems the company did some evaluation of its employees. Starting in October of 2024 and going into the first 3 months of 2025, the company let go of about 4% of its employees. That is about 4 out of every 100 workers. They said it will help them better match their investments with what the market wants. The company expects to pay about $25 million because of these layoffs for the last 3 months of 2024 and the first 3 months of 2025. The company also said they expect to record a charge of about $17 million before taxes in the first 3 months of 2025, and they expect to pay it all in cash. The rest of the money was already counted as a special charge in the last 3 months of 2024. It looks like they are clearing things out to get leaner and meaner. FTI Consulting is using some numbers that are not exactly how they are presented on their financial statements that follow standard accounting rules in the United States, known as GAAP. Some of these measurements are considered non-GAAP financial measures, which the Securities and Exchange Commission cares about. Basically, they're using their own way to show you the money. The company used a few non-GAAP ways of measuring their financial situation, such as total segment operating income, which is basically how much money each section of the company is making, adjusted segment EBITDA, or earnings before interest, taxes, depreciation, and amortization. With some adjustments, total adjusted segment EBITDA, adjusted EBITDA, adjusted EBITDA margin, adjusted net income, adjusted earnings per diluted share, free cash flow. It's like they are fine-tuning their financial picture to give investors a better view. The company says that segment operating income is how much each section of the company contributes to the overall operating income. They calculate total segment operating income by adding up the segment operating income for all sections of the company, but they leave out unallocated corporate expenses. Basically, it shows how each part of the company is performing on its own. Adjusted segment EBITDA is the part of the company's overall operating income before things like depreciation, intangible assets, and special charges. The company uses adjusted segment EBITDA to see how well each part of the company is doing financially, because they think it shows how well they are operating and how much cash they can make. Total adjusted segment EBITDA is just adding up the adjusted segment EBITDA for all parts of the company, without including unallocated corporate expenses. Adjusted EBITDA is net income before things like income tax, other expenses, depreciation, special charges, and gains or losses from selling a business. Adjusted EBITDA margin is adjusted EBITDA as a percentage of total revenues. The company thinks that these ways of measuring finances, along with the regular GAAP numbers, give investors a better understanding of how the company is doing, including the important trends. Adjusted net income and adjusted earnings per diluted share are also ways of measuring finances that are not GAAP. They show net income and earnings per share, but they leave out things like special charges, gains, or losses from selling a business. The company thinks that these numbers, along with the regular GAAP numbers, give investors useful information about how the business is doing and what trends are important. Free cash flow is the amount of cash left over from operating activities after paying for things like property and equipment. The company thinks this number, along with the regular GAAP numbers, gives investors useful information about how well the company can make cash for its business and investments. It's the company's way of saying, here's the cash we have to play with. Non-GAAP ways of measuring finances are not the same for all companies, so you cannot always compare them to other companies. You should consider these numbers in addition to, not instead of, the regular financial statements. These statements include the consolidated statements of comprehensive income and consolidated statements of cash flows. The company also included reconciliations or explanations of the differences between these non-GAAP numbers and the regular GAAP numbers in the press release. If you want to dig deeper, the company included a press release with all the details. So what does all this mean for FTI Consulting? First, let's look at the good. FTI Consulting is clearly trying to streamline its operations, even if that means some tough decisions like layoffs. The focus on adjusted EBITDA and free cash flow suggests they're prioritizing profitability and cash generation, which is always a plus. They seem to have a good grasp on what the company does well and what it needs to improve. Now, for the challenges. The company's reliance on non-GAAP measures could be a red flag for some investors, even if they explain it. You have to wonder if there are things they might be hiding. The layoffs, while potentially beneficial in the long run, could create some short-term instability. It will be interesting to see if they can keep their employees happy and productive while they are cutting costs. Overall, FTI Consulting seems to be taking a proactive approach to its business. The company is trying to make sure that its workforce is matching with market demand. It is something that should be considered. Based on a review of their financials and future guidance, I'd estimate a price range for FTI Consulting stock to be between $150 and $170 in the next year. Keep a close eye on their ability to manage costs, grow revenue, and generate free cash flow. I'm leaning towards a slightly bullish outlook, but with a dose of caution. Thanks for watching, and if you found this corporate deep dive helpful, please subscribe for more.